Hey everyone, this is Kirk here again at OptionAlpha.com. Welcome back to the video trading alert that we do here each and every night on the membership side of our blog. So again, what we're going to do tonight is go over both the opening and closing trades that we send out to just our members. If you're watching this on YouTube or somewhere else publicly online, you just have to understand that you're getting this video about 7 to 10 days after they go out to just our members. So if you want real-time alerts and real-time video updates, you got to sign up for our membership at OptionAlpha.com. Now, we had 2 opening trades today, and then we closed out 3 profitable trades. So even though this market is pretty resilient and continuing higher, which kind of defies gravity, and that's okay, and that's fine. We're still tilted very much to the bearish side, and that's what we're going to continue to do is kind of play this downside potential move in the market. I'd rather be tilted that way than to possibly shift everything over to the bearish side or to the bullish side. Now, that being said, you'll notice that the 2 trades that we opened today are both trades that have positive delta, meaning that they take advantage of generally the stock or the underlying market continuing to move higher. And what we want to do is, although we want to obviously see the market move down, that helps our overall portfolio in general. We also want to add some positions that help neutralize some of this higher move. So if the market is going to continue higher, and it's going to continue higher for the better part of March or April, or continue on through the better part of spring and summer, then we obviously want to take advantage of that and start to add positions that take advantage of that. So as we start taking off trades, we're going to be a little bit more aggressive and also putting on trades that kind of replace those positive betas that we've had in the portfolio going forward. So today I want to talk about the 2 trades that we placed. The first is in Baidu. So we actually have made good money in the past on Baidu and continue to go back to the well on this one. It's a very active stock and the options are very active. So pricing is fairly good on this option as well. And today we traded the 180-190 call debit spread. So it's a little bit wider spread, but this is also good because even though it costs us $4.96 for this trade, which is a little bit pricey for some people for a single trade, we didn't have to enter a lot of contracts, as you can see right down below with Yahoo, where we entered 6 contracts on either end. So a little bit wider spread, and we were able to then save just a tiny bit of money on commissions. But at the end of the day, we're still paying about half the width of the strikes on this debit spread. So the width of the strikes is $10. Our target is just around 5. Our order was actually for 5, and we actually got filled a little bit better than that. So that actually worked out to be in our favor. But all we really want here with Baidu is that we think that after this kind of breakout move that it had here higher, moving today, it was up almost $10 on the day, which is a huge move. And really it was all over the place today and really ended at the high end of the range, which is good, a good sign for the stock continuing forward. But this is a really good hedge against this whole market moving higher. You can see that Baidu has kind of mimicked the market as it's gone higher, and that's really what we want. We don't want a stock that doesn't mimic and kind of copy the SPX as far as when the SPX moves higher, then it moves lower, it moves sideways. We want something that's going to more or less mimic the market going forward, and that's really going to give us that true beta delta that we need. That delta hedge that we need, and that evenness of the betas in the portfolio. So this is a really easy trade. It's a very wide trade. It's just only $500. It is a 50-50 bet, so we'll likely exit this trade well before expiration in April, but it gives us an opportunity to take advantage of the market moving higher. The same thing goes for Yahoo. So Yahoo was actually a good opportunity to sell a credit spread in this market with low implied volatility generally. We sold the April 38.37 put credit spread. Our strikes are only $1 wide, and we took in 32 cents of credit for that spread. So we took in about a third of the width of the strikes, which is usually what we target. So we're trading 70% odds here, 30% chance of losing money on this trade. And if you look at Yahoo with our first strike at 38, we're actually giving ourselves fairly good distance and room here between ourselves and the market. And you'll notice up in the top left-hand corner of my screen that the implied volatility percentile right now is at the 57th percentile. It's a little hard to read because it's in yellow, but it's at the 57th percentile, so it's above the 50th percentile that we talk about in our ultimate strategy guide and deciding when to sell options or when to buy options. And with our first strike at 38 and taking in about a 30-cent credit, actually moves our break-even period down below, our break-even point down below 38 as a strike, but gives us room to be right in this trade even as the market continues higher. So This is a great hedge, again, with the market. It's a very big name stock. It's very highly traded. And so if it does continue higher, we want to take advantage of that, especially because it has really high implied volatility right now. You just don't get these many opportunities to trade something that's on an uptrend with high implied volatility. So we're obviously going to take advantage of that and by making this trade today. Now, closing out today, we had a lot of good trades. You'll notice that we've actually had a couple good trades in some of the financials that we've closed out recently. COF is one of the ones that we closed out a couple weeks ago. And then Citi today and Goldman Sachs. Both of these are debit call spreads that we entered way back in February. So we've actually held these positions quite a long period of time to actually see them turn around and become profits. And that's all you have to do. You just got to hold your positions, kind of stand your ground here with the market. Things become very cyclical. And just when everyone thinks the market's going to continue higher, it goes lower, et cetera, et cetera. So these are two positions that we've actually held for quite a long time to actually see a profit turn out of them. But for Citi, which is right here, we actually sold back to the market our 448.50 call spreads for 138. Now remember, this was a trade that we had made since it was a debit spread originally. It was a 50-50 bet. So we only really assumed that we would kind of make at most $1 or lose at most $1. So the fact that we made about $31 in profit on 4 verticals, that's actually a fairly good trade. So it's a couple, it's about $120 that we made on this trade, but really nice small trade, keep our position size small. Same thing with Goldman Sachs. Before I get to EWW, we sold back to the market the 165, 175 call spread. So you'll notice we did almost the same thing we're doing here with Baidu, in that making our strikes very wide and only trading one contract. And that allows us to, again, save commissions, but also get really, really broad exposure to an option strategy in that particular stock. Now, we bought this for a little over $500 and sold it back today for $730 credit. Again, well before the max potential profit of $10 on this trade. This is a 50-50 bet originally. Now that it's turned into a profit, we felt comfortable selling this thing back to the market, taking in a nice big profit of $187 on the single trade. If I actually go to the charts very quickly of both Goldman Sachs and Citi, you'll notice that when we actually made these trades back in February, I think it was down around here or so, that we actually made these trades. It actually took quite a long time for these things to turn all the way around. And you'll notice that if you had stop losses at this point, you would have been stopped out. But market cyclicality always comes back around. You just keep your position size small enough, and eventually things are going to go your way. With Citi, same thing with Citi. We had traded this thing back in February. I think we traded Citi kind of right around here. And again, it took just quite a long time for this thing to turn all the way around. Actually popped up a little bit here at the end of February and then came back down. So we just held our guns here. We knew we were going to get an opportunity to take some profits off the table and just had to wait for that opportunity. Keep your position size small enough that you can weather these storms, these moves in the market like we're seeing right now where everything seems to be going higher. You got to keep your position size small enough so that you can weather these storms and add more positions to help even out your portfolio. Now, the last one we want to talk about tonight is EWW. We only made this trade about 3 days ago, so this is a really, really quick, profitable trade and really drives home the point of what we talk about with our credit spreads, is that we try to exit these things at about 50 to 75% of max potential profit. So in this case, we took in a credit of $28 and we exited today by paying a debit of 15 cents. So we took in $13 of profit. It's not a huge profit per spread, but if you times that by the 7 contracts that we traded, it's actually a fairly decent sized win for only 3 days. You got to remember, we've only been in this trade for 3 days. Now, what went right on EWW? Well, first thing is, when we traded this stock, it was really, really low and implied volatility was high. And so if you go back to our video tutorial just a couple days ago, I think it was March 3rd that we actually traded this thing, we just ironically enough picked the bottom, which is just pure dumb luck. I'm not going to say that it's a great pick. I wish I could do it every time. But we picked the bottom, so the stock moved higher, which obviously works in our favor with a put spread. The other thing is that implied volatility dropped. Now, when we entered this trade, implied volatility was over the 50th percentile. So we had 2 things work really well for us very quickly. Implied volatility dropped, and the stock moved in the direction that we wanted. Now, we could hold this thing all the way through expiration, but at this point, we've made 50% of the max potential profit on this trade in less than 4 days. Why wouldn't you just exit the trade and move on? And this is really what I like to drive home with people on my coaching program, is that you got to learn to not only get rid of positions that are really, really bad losers and just really dragging you down, but you also got to learn to get out of positions that are profitable. Too many times people get into this business and they try to squeeze out every little ounce. They see a nice profit, 50% of max potential profit, and they want to go after that other 50%, realizing that the market could turn around and take it right back. So I think this is a great example of getting out of a trade early when it shows you a nice profit and moving on to the next trade. This goes into our piggy bank, as you will, for March trades, and that's really what we want. We want to keep continuously exiting these profitable trades all the way till expiration. So again, hopefully you guys really enjoy these videos. I would love to get your guys' comments on these videos, what you guys like, what you don't like. If you have any questions about the trades that we made here tonight, add them to the comment box below the video. I'll get back to all of those comments either tonight or tomorrow before the open, and happy trading.